Big trading educators make fair value gaps sound mysterious. Truth is, they're just showing where buyers and sellers couldn't agree. They're just fancy words for supply and demand imbalances. So today, I'll strip away the complexity and show you how to spot and trade them easily. Fair value gaps show up when price moves fast, skipping over some levels. These gaps happen when buyers and sellers aren't balanced, and traders pay attention to these gaps because they can show where price might turn around or keep going. A fair value gap is a place where price moved so fast, it left a blank space. On smaller time frames, you can see no trading happened there. It's like a vacuum in the market. But these gaps are important because they often act like magnets for price, and the market likes to fill these gaps. This means price often comes back to these levels. They are important because fair value gaps can help you predict where price might go, and they can also help you find good places to enter or exit trades. Markets are always trying to find the right price for things. This is called price discovery. It happens when buyers and sellers agree on a price. But sometimes, the market moves so fast that it skips over some prices. This is how gaps form. Fair value gaps show up when there's not enough trading at certain prices. It's like a jump in the market. These gaps often happen when big players make large orders. They can take all the available trades, leaving a gap. The market wasn't balanced. On one side, there were more buyers or sellers than on the other. And this imbalance can give us clues about where the market might go next. Fair value gaps often act like magnets, and the market likes to fill these gaps. It's like the market wants to go back and check if the price is right. Now, there are different types of gaps. Some happen when the market opens higher or lower than it closed. Others, like fair value gaps, happen during trading. They all show times when the market moved fast and left some prices untested. Fair value gaps will help you see the market's memory. It remembers these gaps and often comes back to them. This can help you predict where price might go or find good places to enter or exit trades. Now, let's address the elephant in the room. There are hundreds of fair value gaps every day. If you trade every gap you see, you'll slowly burn your account. The reality is that fair value gaps are just one piece of the puzzle. On their own, they don't give reliable signals. They work with other market signs to give a full picture. We'll talk about this later. Now let's talk about spotting fair value gaps on your charts. We're looking at a specific 3-candle pattern. For a bullish gap, check if the upper shadow of the first candle doesn't touch the lower shadow of the third candle in the sequence. The space between them is your fair value gap. For a bearish gap, check if the lower shadow of the first candle doesn't touch the upper shadow of the third candle. This area is your fair value gap. The market makes these gaps when big players make aggressive moves. This happens because there's not enough trading activity in that price zone, creating what we call a liquidity void. Think of it like this. A fair value gap shows up during a quick price move where one big player grabs all the available trades. This creates a space where almost no trading happened. The trick is to spot when these candles don't overlap. So in a bullish gap, the high of the first candle shouldn't touch the low of the third. In a bearish gap, the low of the first shouldn't touch the high of the third. When you're looking for these gaps, pay attention to the market structure too. Bullish gaps often show up at support. Bearish gaps tend to form after a rise to resistance. Like I said, in theory, these gaps show up when big players make moves. They can grab all the trades at once, marking an imbalance on the chart. So fair value gaps are closely tied to market structure. They often form at key points in the market's movement, giving us clues about where price might go next. In a bullish market structure, fair value gaps typically form during strong upward moves. The gap shows where buyers were so eager that they skipped over some price levels. This can be a sign that the upward trend is strong. In a bearish market structure, fair value gaps form during sharp downward moves. Here, sellers are pushing the price down so fast that some levels get skipped. This can indicate that the bearish trend has strength behind it. Fair value gaps can also mark potential turning points in the market structure. If price returns to fill a gap and then reverses, it might signal a continuation in the existing trend. When looking at market structure, consider different timeframes. A fair value gap on a smaller timeframe might not be visible on a larger one, but it can still affect how price moves in the short term. Remember, structure is all about support and resistance levels. Fair value gaps often act as these levels. Price tends to respect them, either bouncing off or breaking through them with force. In ranging markets, fair value gaps can mark the edges of the range. Price might bounce between these gaps, creating a clear structure to work with. But please understand that these gaps don't exist in isolation. They are part of the bigger picture of market structure. They work alongside other elements like trends, support and resistance, and market phases. If you trade them on their own, you have small chances to make profits. So when you're analyzing structure, look for patterns of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Fair value gaps often form during the strong moves between these swing points. A quick word on timeframes. There can be hundreds of gaps in a single trading day, and they can appear on various timeframes. On shorter timeframes, fair value gaps are more frequent, but have less significance. They can be useful for scalping or day trading when looking for quick entries and exits. But these gaps might get filled quickly, so you need to be fast to act on them. Longer timeframes, like 4-hour or daily, show fewer gaps, but when they do appear, they often have more impact. These gaps can influence price movements for several days. I personally like to use a multiple time frame analysis when working with fair value gaps. For instance, you might spot a gap on a higher time frame, mark the zone, but then zoom in to a lower time frame to fine-tune your entry or exit points. Remember, price is fractal. Patterns that appear on monthly charts can also be seen on daily or even 5-minute charts. This principle applies to fair value gaps as well. When trading fair value gaps, timing your entry makes the difference. The plan is wait for price to come back to the gap before entering your trade. This strategy works well because these gaps are pulling price back to areas where little trading occurred. Think of this gap as a vacuum in the market that needs to be filled. From a supply and demand view, here's what happens. First, a big market player enters with massive orders. They hit the market so hard and fast that price jumps, creating that gap. During this jump, regular traders can't keep up with the speed, leaving an area where trading activity is super thin. When the gap forms, it creates an imbalance. On one side, you have lots of orders filled, but on the other side, there's barely any trading activity. This imbalance creates a zone of interest that big players watch closely. So the smart move is waiting for price to return to this gap. That's because market makers must find fair value for their positions. They use these gaps as reference points, and when price returns to fill the gap, it's often because market makers are balancing their books. You'll notice something interesting when price comes back to these gaps. It's trying to restore balance between buyers and sellers. This balancing act happens from 3 reasons. Market makers need to fill their unfilled orders from the original move. Also, other traders spot the imbalance and try to profit from it. And finally, the market naturally seeks equilibrium at these levels. The key to trading these returns lies in understanding the original move that created the gap. If it was a strong upward move, a bullish displacement, the gap below becomes a potential buy zone when price returns. The opposite is true for downward moves. Think about the mechanics. When that initial big player moved the market so fast, they left behind other traders who missed their chance to enter. When price returns to the gap, these traders often jump in, adding to the trading activity at these levels. So from a pure supply and demand perspective, the fair value gap represents a level where demand suddenly overwhelms supply in an upward gap, or supply overwhelmed demand in a downward gap. The market needs to test these levels again to confirm if that imbalance was temporary or part of a larger trend. The return to this area often shows clear price action signals. You might see price slow down as it approaches the gap, or notice smaller timeframe consolidation patterns forming. Watch how price behaves when it returns to fill the gap. Clean, swift moves through the gap might indicate that more movement in that direction is coming. Choppy, slow price action might suggest that the level is being heavily contested between buyers and sellers. So for a bullish setup, wait for price to return to the lower edge of the gap. If price bounces off this level, it could signal a good entry point for a long trade. For a bearish setup, watch for price to come back to the upper edge of the gap. If it struggles to break above this level, it might be a good spot to enter a short trade. While waiting for price to return to the gap, look for specific candlestick patterns to fine-tune your entry. These patterns can give you extra confirmation before you enter a trade. For instance, if you see a bullish engulfing pattern form at the lower edge of a fair value gap, it could signal a strong buying pressure. This might be a good time to enter a long trade. A long wick at the upper edge of a bearish gap could indicate selling pressure, implying a potential short entry. Fair value gaps with a break of structure create powerful trade setups because they combine two major elements that show us exactly where big players are active in the market. A break in market structure happens when price runs through previous swing highs or lows with force, but this break needs a gap inside it to count as valid. Picture the market moving up in a series of higher highs and higher lows. Then suddenly, price drops hard through a previous swing low. During this drop, if we see a gap where the candle wicks don't overlap, that's our gap. Big players pushed price down with real force. This area become a magnet that pull price back later. Another example, you see price moving up, making higher highs. Then a large player hits the market hard, breaking below a key swing low. During this break, 3 candles form. The middle one creates a gap. This gap implies the break-in structure might be real. This combination works well because it shows 2 things. The market structure break tells us the trend is changing, and the gap shows us exactly where big players left their footprint. The presence of both signals means more than just a random price move. It shows intentional, institutional trading activity. When price returns to these levels later, it often finds strong support or resistance. What makes this setup special is the vacuum effect created by the gap. Remember that during the fast move that broke market structure, some orders didn't get filled. This creates an area where price needs to return to find fair value. You'll notice these setups work best when 3 conditions are met. First, when the break-in structure is clean and strong. The fair value gap forms right at the point where structure breaks. And third, price moves away quickly after creating the gap. So when market makers move price fast enough to break structure and leave a gap, they're showing their hand. They're telling us they have strong interest at these levels. The same for a buy signal. Look for a clear break of previous swing highs. Check for a gap forming during this break. Then wait for price to return to the fair value gap level. And watch how price reacts when it hits the zone. The setup becomes even stronger when the gap coincides with the actual breakpoint in market structure. This creates a double reference point that market makers use to balance their books. The liquidity void that comes with the fair value gap adds another layer of confirmation. It shows that one side of the market was completely overwhelmed during the move. This imbalance needs to be corrected, which is why price often returns to these levels. So after spotting the break in structure and gap, don't chase the initial move. The best trades come when price revisits these levels and shows clear reaction. This gap becomes a key reference level for the new trend direction. Supply and demand zones mark the spots where smart money builds positions. Think of them as launching pads where big trades start. When you find a fair value gap near these zones, you've spotted a place where institutional traders showed their hand twice, first building positions, then moving price fast enough to leave a gap. The strategy works through a simple market truth. Price wants to trade where it hasn't traded before, and those gaps represent prices where little to no trading happened. Markets need to fill these gaps to find fair value. That's why price often returns to these levels. Watch how this plays out on charts. First, you'll see price moving normally. Then suddenly, a large candle appears with no overlap to nearby candles. This tells you someone big just moved with purpose. If this happens near a supply or demand zone, pay extra attention. The process follows clear steps. Price builds up in a supply or demand zone. Then it moves explosively, creating the gap. This fast move shows institutional conviction. Later, price must return to fill this gap. Another signal. You see here a clean fair value gap, where candle shadows don't overlap. The bigger the gap, the stronger the signal. As this gap forms near this demand zone, you've found the sweet spot. Then you wait for price to return to the gap area. Watch how it reacts. Strong moves often follow once the gap starts filling. In combination with a supply or demand zone, I don't mind if price completely fills the gap and even moves past it. I always wait for it to return to the origin point, to the demand zone. The technical reason this works ties to liquidity. Gaps mark areas with little trading activity. When they sit near supply or demand zones, you get two powerful forces working together: the need to fill the gap and the strength of the original zone. Your edge comes from spotting these combinations early. Look for clean gaps. Check if they formed near strong supply-demand zones. Also, remember the previous chapter. Look if this move caused a break in market structure. These setups offer clear entry points with defined risk. This is a clear example of how big players move markets. They build positions in zones, create gaps with fast moves, then let price return to fill them. Each step leaves clues on charts through price action. Price moves this way because markets seek liquidity. This creates a rhythm you can trade: accumulation, expansion, gap creation, then gap filling. Fair value gaps in premium or discount zones show where smart money plans their moves. Market makers work in specific ways at these spots. In discount zones, they start buying. In premium zones, they start selling. This creates a rhythm in the market, a back and forth movement you can trade. The power of this setup comes from market maker behavior. They need to do fair valuation for both their entry and exit positions. This means they look at premium and discount zones as places to start big moves. You need to see the bigger picture first. Look at the total range of the larger price move. Find where price sits compared to recent highs and lows. Then spot the reference points market makers watch, the fair value gaps and liquidity voids. The middle ground, called equilibrium, marks the 50% point between swing highs and lows. This helps you know if price sits in premium or discount. Market mechanics make this work. After big market moves, most traders chase the trend. Smart money does the opposite. They expect a pullback before the next move. These pullbacks often happen right at fair value gaps in premium or discount areas. The process shows up clearly on charts. Sharp price runs left behind gaps, areas where little trading happened. These spots become targets for future trades. When they sit in premium or discount zones, they mark prime trading opportunities. So watch how price behaves in these zones. In premium areas with a fair value gap, look for selling pressure. In discount areas with gaps, watch for buying pressure. The mix of zone location and the gap creates stronger signals. Remember what we talked before. Market structure plays a key role too. True breaks in structure often leave gaps behind. These gaps confirm the break's strength. When they form in premium or discount zones, they show even more power. Again, the best trades come when multiple factors line up. Zone location, gap presence, break-in structure, and clear price action. Market makers use these areas to build positions. They accumulate in discount zones and distribute in premium zones. And finding gaps at those spots shows you where they plan to move price next. The strategy works because it follows market maker goals. They need to find fair value for positions. Premium and discount zones mark places where they take action. Fair value gaps in these zones show exactly where they moved with force. Best trades develop this way. Price reaches a premium or discount zone. You find a gap nearby. Then price shows reversal signs. The whole process repeats in cycles. Price moves between fair value, premium, and discount, and each cycle leaves gaps behind. Fibonacci levels match natural market moves, and when they line up with fair value gaps, they create strong trade opportunities. Think of it like using two different tools that point to the same spot. It makes that spot much more special. The magic happens because different types of traders watch different things. Some traders only trade fair value gaps, while others only use Fibonacci. When these levels match up, both groups of traders see a good trade opportunity. This creates more buying or selling pressure at that exact spot. The golden zone between the 50% and 61% Fibonacci levels attracts smart money attention. When a gap sits in this area, you've found a place where two powerful forces meet. This double confirmation makes your trades stronger. In an uptrend, look for gaps that line up with Fibonacci levels for buying opportunities. In a downtrend, search for gaps matching Fibonacci levels for selling chances. Think about how markets move. After a strong push, price pulls back to test previous levels. Smart traders use Fibonacci to find these pullback targets. When these levels match a fair value gap, they show where big players plan their next moves. The process starts with finding the right swing points. Draw your Fibonacci from the highest high to the lowest low in the recent price action. This gives you the framework for finding the sweet spots where a fair value gap might matter most. A lot of big traders watch these same levels. Some use Fibonacci to plan their trades, looking for spots where they can build or exit positions. And when you see a fair value gap at these levels, you might want to take action. The real power comes from understanding what these confluences mean. Fibonacci levels themselves don't act as support or resistance. Instead, they help you find liquidity blocks, places where fair value gaps show market imbalances. Then watch how price reacts at these spots. A strong gap needs a big, clean separation between candle shadows. When this gap lines up with key Fibonacci levels, especially the 50 and 61% zone, you've found a high probability setup. The strategy works because it combines two types of market psychology. Fibonacci shows natural pullback points where traders expect reactions. Fair value gaps show where big money moved fast enough to leave traces. And together, they create stronger signals. Remember that trends make this work better. In a strong uptrend, gaps that line up with Fibonacci levels make great buying zones. The opposite works in downtrends. The trend gives you another layer of confluence, making your trades even stronger. The plan is simple. Wait for price to reach the Fibonacci level where your gap sits. Look for signs that price respects both the level and the gap. The best trades come when price pierces the confluence zone and rejects it with a strong candlestick signal. I look mainly for candles with large wicks or engulfing patterns. Time frames matter too. While this strategy works on any chart, I often watch the 4-hour and the hourly charts. These longer views help you spot the strongest confluences between Fibonacci and fair value gaps. Again, the technical reason this works ties to liquidity. Big players need certain price levels to build positions. They use Fibonacci to find these spots. When they move fast enough to create gaps at these levels, they show their hand twice. Trading becomes simpler with this approach. You don't chase price. Instead, you wait for it to reach these special spots where Fibonacci and fair value gaps meet. This patience puts you in position for high probability moves. The whole process flows naturally. Markets move up or down with force, creating gaps. Price pulls back to Fibonacci levels. When these align, you find spots where smart money are likely to act. Think of confluence like different layers. Each layer, like the gap, Fibonacci, trend direction, the candlestick confirmation, makes your trade setup stronger. The more layers of confluence you have, the higher the probability of your trade working out. And use these confluence zones as areas, not exact prices. Markets rarely turn exactly at a specific price. Instead, they often react within a zone. So give your trades room to breathe by thinking in zones rather than exact prices. I prefer this approach because it also helps you avoid many fake breakouts. Instead of chasing price, you're waiting for it to return to these high probability zones. This patient approach will keep you out of those common breakout traps that catch many traders. Now, if you want to learn other smart money tactics, you need to watch one of these videos next.